Looking at the current crypto news today, Satoshi Nakamoto appeared on Twitter/X very recently. It's a friend of Craig Wright's. From CTKSnews.com, if you go across to the market analysis, you can see key macroeconomic data releases. The Bureau of Labor Statistics puts out the Job Openings and Labor Turnover Survey, or the JOLTS, Job Openings Report, about 35 days after the month ends. These are all high-impact reports. Now, the one thing that we noticed, the actual ticked up. The forecast was expecting down. This surprised the market, and when markets get surprised, they don't behave correctly. They behave badly. The JOLTS, Job Openings Report, was basically saying there's so many job openings inside the economy. The economy is growing strongly. And of course, that sent yields skyrocketing. Because a strong economy means the economy is overheating. Inflation could come back in. Then the market got the ADP report from Automatic Data Processing Inc., which analyzes the payroll data from more than 25 million workers. And the ADP employment change doesn't come out 35 days after the month ends. It comes out the first Wednesday after the month ends. The JOLTS Job Openings Report comes out 35 days later. We can see from the chart they were expecting and forecasting a lot more than actually occurred. This smacked yields down. And when yields came down, the DXY followed it. The ISM Services PMI, that is the Institute for Supply Managers, Purchasing Managers Index. You can see that the number released here was 53.6. Above 50 indicates industry expansion. Below that indicates contraction. The ISM Services PMI is a survey of about 300 purchasing managers, which asked the respondents to the rate of relative level of business conditions, including employment, production, new orders, prices, supplier deliveries, and inventories. And of course, when the Fed looks at this, it's looking for signs of inflation. Now we need to look at the charts to see what all of this meant. Just to let you know, if you scroll down a little bit more, you can see all of the US stocks across all of the sectors, and a little bit more down, you can see the crypto market currently. That is from CTKSnews.com. On Tuesday, October the 3rd, Fed Chairman Powell gave his speech. The rates will stay higher for longer, and we can see the resultant remark here. Ouch, look at what yields did. The US 10-year just went nuts. That was followed by the JOLTS Job Openings Report, and you can see that yields just spiked a little bit further, and then they utterly decayed. Somebody was talking about the ADP non-farm employment change. They expected 154,000, they got 89,000. That's a huge reduction. The market's already told us the news. All charts are intercorrelated and interconnected. When Fed Chair Powell said rates will be higher for longer, that absolutely shot into Bitcoin's price action. But as the JOLTS Job Openings Report came out, look at what happened. Bitcoin rallied. Now it's slightly retracing on the ADP results, but Bitcoin is largely positive. The one thing that we understand, all price structure moves between structural support levels and structural resistance levels, and we can see that playing out. Bitcoin had very strong structural support levels below the current price. When Fed Chairman said, rates higher for longer, we literally came down and pinged these support barriers. That's why it's so important to know where actual support is inside the market. Now, these lines may look like they've just been drawn up from recent indicative price, but they have not been. They've been drawn up since 2009. And you can see this level of resistance at 27,826 played out almost perfectly. Price came up, tapped it again, and couldn't get through it. It's trying to breach that particular level at the current time. And you can see in the past, it held price as well. Knowing where the safety nets are is vitally important. It's as important as knowing where structural ceilings are as well. It's extremely important to keep your eye on junk bonds, and here you can see Fed Chair Powell saying rates higher for longer, and that brought junk bonds down. Higher interest rates make junk bonds very unattractive. Then the market again was jolted by the JOLTS report, and then the ADP report. Why do we look at junk bonds? That overlay is the S&P 500. You can see that it's aligning incredibly well with junk bonds. What is this gold line here? It's Bitcoin, and you can see Bitcoin is very risk sensitive. It detected the potential movement inside the stock market before the main market did. What about the US 2-year yield? We can see an inverted relationship between the two of them. I'll show you what I mean. I'm going to invert it now. The nature of this inverted relationship is just one more probability that you can stack. The key is, just like in Bitcoin, price is always moving in a wave between structural support and structural resistance levels. It's very important to keep our eye on the crypto market. It trades 24 hours a day, and it's all about risk, risk, risk. It can give a very good insight into what will happen inside main markets. And we can see right now Bitcoin is doing very well. You can also see this blue line. That's Bitcoin's gravity. No alt can escape that blue line. That's why we need to look at it. If Bitcoin is coming up, guess what? The alts are coming up too, and vice versa. We can also look at the Tier 2 and Tier 3 alts to confirm what could be happening with Bitcoin. Is it strong or is it weak? Stacking probabilities through currencies is another fantastic thing that you can do. Any edge you get inside financial markets will pay very, very well, but you have to look far and wide. The DXY typically has an inverted relationship between itself and Bitcoin, but not always, but generally so. And so therefore we can look at the euro dollar or the fiber, and we can see as the euro dollar was crashing down, Bitcoin was starting to consolidate. And what have we seen since? Bitcoin come up and the fiber come up. All markets are intercorrelated and interconnected, and you can use one chart to get an edge on understanding another. For example, the alts and Bitcoin cannot escape the US stock market's gravity, and we can see that playing out. Because crypto is very risk sensitive, we can use that information to guide a decision as to what could happen with the main markets. And we can see here that the S&P 500 futures since the 4th has actually been coming up. And we can see the same thing with Bitcoin and total crypto market capitalization. Total just reflects off to all of the other alts, including Bitcoin. If total is coming up, there's a very strong probability that your alt is coming up with it. This is very good news at the current time because we've seen the main markets pretty much melting down recently. When the US markets melt down, the rest of the world tends to follow. Traders are always seeking to determine changes in trend in the main markets. There are lag effects because not all exchanges are open at the same time. Also, macroeconomic factors weigh on every and each country. But in general, if the US is coming up, all of the stock markets are coming up as well. And Bitcoin, being so sensitive, that's the blue line there, can give us a bit of an indication. It's a stacked probability. Markets are statistical by nature, and what that means is they're run on probabilities and not certainty. We've seen extreme fear enter the main markets. Let's look back in history to when extreme fear was around this level. We can see that there was extreme fear around March 15th, but there's more fear inside this market. Let's look back to March 15th on junk bonds. What we can see here on March the 15th, that's when we got that extreme fear reading inside the main market. The blue overlay here is the S&P 500. From around that point, the S&P 500 already bottomed out several days before that, and then it just shot up. That would have been a time that everybody was expecting a credit event. It would have been the time that everybody was saying the markets are going to melt down. But they actually didn't. They rallied. Warren Buffett and many others are famous for saying, buy when there's blood in the streets. There's a lot of blood in the streets now. A lot of people will be thinking about buying as the last thing on their mind. They will actually say, "Oh, it could go lower, I want to buy the bottom." Dollar cost averaging in is a much better way of looking at things. If you believe in what you're doing, if you see long-term prospects, there's no problem in DCAing. Could the markets crash and burn? That largely depends on structure. If there's significant structural support underneath the variety of different charts, and what I mean is underneath junk bonds, underneath the S&P 500, underneath the Nasdaq, and then we have to look across to see what the US 2-year, the US 10-year, the DXY is doing. We also need to look at gold, Bitcoin, and a wide variety of other charts in order to stack probabilities effectively. As all markets and therefore charts are intercorrelated and interdependent, one chart can give an insight on another chart. And the more charts that you look at, especially from a structural perspective, the greater will be your understanding of how the markets actually move. The key charts to focus in on are the Tier 1 charts. The service has videos explaining the structural levels and three-dimensional risk management curves out to the end of the month. The Nasdaq has been released, the DXY, Bitcoin, junk bonds, the US 10-year, and total, as well as the 2-year yield. The structural levels on the S&P 500 will be coming out in the next 24 hours, as will other charts. Doing your daily three-dimensional risk management is utterly critical. The thing that traders excel at is buying and selling. The selling part of that equation is really important. It's very easy for investors to get locked into a position and then see it absolutely decay. Traders and investors need to be aware of what's called the doom cycle. When an unexpected negative outcome occurs, especially when it comes to money, people get very, very upset. In financial markets, losses are the tuition fee of the market. But nobody is told this. Except of course inside the masterclass and on the daily video I share Rule 212, markets demand the tuition fee of losses. When you get a loss, there's two ways to deal with it. You can externalize the cause and disempower yourself, moving into blame. Blame is very disempowering because it actually leads to a compounding of losses, not a correction to them. The doom cycle is that the anger and hatred and all of those negative emotions spill into everything in life. Whereas when we have understanding of Rule 212 that I've been sharing since 2021, we understand those losses are a signpost to the concept that we must create rules surrounding our behaviors. Any unexpected negative outcome can be dealt by just owning it, learning from it, being kind to yourself, forgiving yourself for the loss. Life is not just about money. When money is the central focus of a person's life, it can make them crazy. There's so many other things in life. Money is a byproduct. It's important, but it's a byproduct. The key is to grow in strength, to gain the lesson from the loss. That's why we call them in our community lossons. If you're in a situation that you've made big losses, what it actually means is you're very close to a professional level inside the market. Inside Zone 1 and Zone 2, and these are the 4 stages that every single investor and trader progresses through to become consistently profitable. Zone 1 and Zone 2, losses don't occur. It's a 0% loss and a 100% return. That's crazy. It violates the rules of financial markets. Over time, people learn to understand it's not about certainty, because as soon as the markets are certain, they change character. Unfortunately, Zone 1 and Zone 2 are low knowledge zones. How do we get higher knowledge zones and higher skill zones? Through learning. And that is the bridge that connects and leaves behind Zone 1 and Zone 2 into Zone 3 and Zone 4, where we make money and keep it. That's why every day I talk about three-dimensional risk management and preparing yourself. You control the trader or investment, but the market controls the return. And your returns are always based on your active learning, your knowledge plus your courage. The market always penalizes blame and gambling. If we go down the blame path, we enter the doom cycle. And how a person does one thing is how a person does everything. If we enter the doom cycle, there's a high probability the doom cycle is playing out in relationships, at work, inside the market, just everywhere. There's no happiness or meaning inside the doom cycle, but it's very easy to break out of. All you do is say, unexpected negative outcomes. I'm not unexpecting this, I'm expecting this. This happens until I know the rule. If you know that each time you're paying for a lesson, that's good, because it doesn't matter who you listen to, where you go, you will always pay tuition fees from the market. The key is to get away from news-based stories that incite emotional reactions and start to move into structural understanding. Focusing your attention on the structural levels inside the Tier 1 charts is an absolute game changer. As you move more and more into the professional level, you will know that there are absolutely news events such as Fed Chairman Powell talking about rates higher for longer, but when it hits structural levels, especially quite a few of them, things tend to bounce. If you can keep your eye on structure, you will know where the buyers are coming in and where the sellers are coming in as well. I always urge you to write up your own rules. The more rules that you collect, the less losses you will make. And of course, the more profit you will make as well. Your profitability is directly dependent on the number of rules you have. If you don't have any rules, that probably answers the question. I would suggest that you acquire the skill because the money always follows. No rules means that you're making losses, and they consequentially can and must compound until you learn that lesson. Entering the doom cycle just dooms you to repeat ever-increasing losses across all aspects of your life. Of course, this is not the touchy-feely thing people want to hear, but it's the truth. Always remember, if you're going through a tough time, you are who you are because of the tough times, not because of the easy ones. As a community, we always solve our problems through positive excellence. Positive excellence is the foundation of Zone 4. And the foundation of Zone 1 and Zone 2 is the opposite to everything you see here. It's negative excellence. And that's precisely why people make losses. They subscribe to negative excellence, which is, I'm not putting in the work, I'm just going to put the money down and I'm guaranteed that it will all work out. There's a big lesson right there. You can create a rule out of that. If you don't put in the work, you're going to lose money. If you gamble, you're going to lose money. If you don't know what you're doing, you're going to lose money inside financial markets. Just think about it this way. If you go to a new job and you don't know what you're doing, you're going to lose that job, because you don't know what you're doing. If you play a new sport and you don't know the rules, you're in all likelihood not going to play very well. It's the same rule for all of life, but people think that financial markets are somehow magically, mysteriously different. You can earn 1000x with 0% loss. This is absolute fantasy. The key is to don't go all in and more. Start small and scale. Understand the market pulse by stacking probabilities. The most important thing that you can do is never get sucked into recent indicative price. When you know what it is, you can see it so easily. It's trend lines drawn to the current price and stories to go wrapped around those lines. That is not structure. To avoid the doom cycle and to make it easy to learn from lessons, we have the CTKS creed. Better habits create a better life, and the best habit that you can ever get is do not blame. When anybody blames, they enter the doom cycle and they compound their losses not just in the area concerned, but in every area of their life. It absolutely dooms them. That is actually why it's called the doom cycle. It's very natural to enter the doom cycle. It's Zone 1 and Zone 2 behavior, and unfortunately our education system doesn't teach people how to not enter the doom cycle. It teaches them to enter it. No wonder we have an absolute epidemic of depression, misery, and lack of meaning across the entire globe. The beautiful thing is you're in financial markets, the fastest road to self-development. Here, in financial markets, self-development is not optional, it's compulsory. Many people say, oh no, I don't want to be in it then. Of course, that's your choice, but the concept is if you can learn from the losses that you make and know that they're just to be expected, That's a completely different thing. You'll master the markets. But it all starts in getting out of the doom cycle. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.